Hello everyone, welcome back. Here is Ali Talabi, and this is the third module of our finance classes. So, today we are going to talk about finance and accounting. Actually, this module is divided into two sections, and both sections we cover financial statements, and we'll talk about four different financial statements. But in the beginning, and the first lesson, I'm going to talk a little bit regarding the relationship between accounting and finance. Many of you, maybe you are planning for the future, going to the job market. Some of you, maybe you are already in the job market. Maybe you're switching to go from accounting to finance or vice versa. So it's good to just have a broad perspective regarding the differences and similarities. When it comes to accounting, and usually when I'm talking about accounting, I'm talking about financial accounting because managerial or management accounting, it's a little bit different than traditional accounting. I mean, the financial one, the financial accounting. So in financial accounting, one of the major jobs is to prepare the financial statements, to record the transaction, just to make sure everything is recorded correctly in a timely manner and also efficiently. However, when it comes to finance, we are using information which are prepared by accountants. The financial statement we use to analyze the data are prepared by the financial accountants. So you see that it's not just about preparation, it's more about analysis, interpretation, and description of the numbers. So it's kind of important, the information we are getting from accounting. So if financial statements are not reliable, there are some issues with that, for sure, the analysis won't be good or efficient. So another job in this area is auditing. So for sure you heard about the auditing financial statements. So that's the job. If you are an auditor, your job here will be just to make sure the financial statements are compliant with rules, regulation, and some standards, including IFRS or GAAP. So that's the kind of general idea. As I mentioned in this module, we are going to talk about financial statements. We have four major financial statements. The first one is called balance sheet or a statement of financial position. In the balance sheet, what we do, we are actually talking about what we own, assets, and what we actually owe. So liabilities and shareholders' equity. It is showing what we owe. Here is showing what we own. Or in other words, that's what you have, your assets, and what you have to pay back to your either debt holders, liabilities, or shareholders, shareholder equity. So this is a famous accounting equations, and you see this in the balance sheet. So assets, liabilities, and shareholders' equity. We'll talk more about this later, but just make sure that you know these are three major fundamental parts or accounts of each balance sheet. Another major financial statement is income statement. And when we talk about income statement, most of investors are more toward more toward income statement because it is showing actually the how much the company is earning or getting, how much the company is making, and also it is showing the expenses. So it's showing the summary of revenues, it's showing the summary of expenses, and for sure we know whatever is left at the end, it is called net income. So it's important for us how much companies are actually making. So net income higher is better, as investors they will get more earnings. And when I'm talking about the revenues, mainly it's service revenue or the sales revenue, and expenses might be operating expenses, non-operating expenses. Again, we'll talk about this more later, but the whole idea is we want to see how much is left for shareholders' net income. And for sure, the interest expense that you are paying to the bank or the debt holders, it's part of the expenses here. So balance sheet or a statement of financial position, income statement. And the third one is called a statement of changes in shareholders' equity. This is the one which is maybe less well known or actually less famous. However, it is providing important information. It is showing what is happening, the shareholders' equities of the firm over 1 year. So, and when we talk about the shareholders' equity, you have to be careful. We talked about this before, and as I mentioned, shareholders' equity has two major components. One is called share capital or contributed capital. Just for now, let's call it capital. And the second portion is retained earnings. The retained earnings is showing actually how much income is left at company after paying out the dividends. So it shows the accumulation of income over time after paying out all the dividends. Now, let's be a bit more specific. What is the connection between all these statements? So one is talk about the assets, liability, shareholders' equity. The other is talk about the net income, and the third one is talking about the changes in shareholders' equity. So I'm going to show you the connection between these three financial statements. So just let's be more specific here. So when you are preparing the balance sheet, you see you have three major items: assets, liabilities, and shareholders' equity. So usually we start to prepare the balance sheet. That's the starting point. However, when you want just to prepare the balance sheet, you see one of the major items is shareholders' equity. So you need to know the capital, you need to know the retained earnings. Now, the question here is, what is the retained earnings? We had this conversation before. We know the retained earnings is based on actually two major components: net income and dividend. So net income, that's how much you get after paying out all the expenses over the year, and dividends, that's how much you are paying to your shareholders. And for sure, if you have any retained earnings from prior or previous year, you can add to this argument. So net income, where that net income comes from, you're right, it's coming from your income statement. So here is 1, 2, and 3. So that's the order. For the balance sheet, you need to know the shareholders' equity. To know the shareholders' equity, you need to know the retained earnings. To know the retained earnings, you need to know the net income, which comes from your income statement. So this is the order, and for sure, the statement of changes in shareholders' equity is showing that how much retained earnings is changing over time, how much your capital is changing over time. So it's very important piece of information, but you cannot prepare the changes in shareholders' equity if you don't know how much you made over the last year. That's why we need to have our income statement here. So that's a connection between these three statements. Now, when we talk about the financial statements, the first three are more appealing in accounting. When it comes to finance, one of the major differences which you notice in finance compared to accounting is cash, and how we deal or how we define the cash and net income actually in finance. We are less concerned about the non-cash income or non-cash revenues and non-cash expenses, and we are more concerned about the actual cash. If you look at these three financial statements, you see here we talk about revenues, expenses, net income, shareholders' equity. These are mainly based on what we call accrual basis accounting. And what is that, Ali? Accrual basis accounting? Accrual, it means that actually you don't care about the cash transaction. You're more concerned about the transaction itself. For example, if you are committed to sell an item to a customer, you sign the contract to deliver the item, and you received some money from the customer, you cannot record that as a revenue since you haven't done the job yet. So you receive the cash, you have the actual cash, but this cash is actually liability for you. So from accounting perspective, you cannot record that as the actual revenue. So you see, this is the accrual basis accounting. And sometimes the opposite case might happen. Maybe you are providing some service to a customer. However, you will receive the money sometime in the future. So you cannot, you don't receive the cash, but you can actually record that as a revenue, as a service revenue, but you don't have any cash. So you see, this is accrual basis, but in cash basis, it's more about what type of cash you receive, how much cash you receive, or how much cash you are paying. So that's why maybe these three statements should be dealt with more caution when it comes to finance. However, what we have in finance, it's not focusing on income or net income, or sometimes we'll talk about the profit or net profit. We are more concerned about the cash flow. How much cash is coming to the firm? How much cash you are paying to your, for example, debt holders or to your suppliers. So you're more concerned about the flow or the direction of the cash. It's cash inflow, it's cash outflow, operating cash, investing cash. That's why we're talking about the fourth type of financial statement, which is called cash flow statement. In the next lesson, we'll talk about the last or the fourth form of financial statement, which is called the statement of cash flow or cash flow statement. And we'll talk about different sources of cash and how we can distinguish between those and how we can use actually the cash flow statement to prepare the free cash flow, which is very important in the world of finance. Till then, bye. Talk to you soon. This is Ali Talabi, and have a wonderful day.